Stocks and bonds were flat in April as markets took a temporary pause from the crisis engulfing the U.S. banking sector. With that crisis resuming once again in early May, signs of credit tightening are already emerging among U.S. banks as contractions in business and business real estate lending have begun. Similar signs have historically preceded a pause in previous Fed rate hiking cycles. We expect 2023 to be no different. Should the Fed pause take shape over the summer months, investors should expect gold to continue to be well bid, to as much as $2,200 an ounce. The prospect for a turn in global liquidity in the months ahead should also introduce renewed volatility, which should serve as a tailwind for gold. Recall the injection of nearly $2 trillion by global central banks since November has served as the catalyst for the rally in global equities over the past 6 months. Starting in June, the ECB should begin to withdraw nearly 700 billion euros, while the U.S. Treasury could drain as much as $400 billion once the U.S. debt ceiling issue is resolved over the summer. All of this should come as growth in the U.S. economy should continue to slow moving into the summer, creating the prospect for an outright recession looking into year-end. As these events take shape, we expect bond volatility to remain elevated, with equity volatility joining it, following the easing of volatility alongside the central bank liquidity injection since last year. This means that investors can use structured product carry strategies as an income alternative following the year-to-date decline in bond yields. This income should complement our preferred high-quality credit exposure, which has already outpaced U.S. equities year-to-date. As volatility returns in the months ahead, high-quality bonds and gold offer investors not only shelter, but also attractive risk-return potential amidst economic and policy risks in the months ahead. For more details on how we have prepared for an end to the Fed rate hiking cycle and the ongoing turmoil among U.S. banks, please visit us on ubp.com.